Here's a perfect example on the 4 setups I was going through. Number 1, the zone. Number 2, the zone break. Number 3, retracement. And number 4, the entry. So I'm going to add these in at the top as text. So 1, our zone. Number 2 is our zone break. Number 3, our retracement. And number 4, our entry, or our zone touch. So obviously this is the dollar yen. It's in a huge downtrend. It's on a monthly time frame. It's making lower highs, and it obviously is trending down. So when it gets to the very bottom, we just kind of want to just obviously be a part of that though. But we also want to know, well, when do we not want to be a part of it? So the idea here is to look at this chart, and when you're trading supply and demand, we know that all these little peaks here are areas or pockets to sell the market. So that's why we mark all these and we leave them there, and we tell ourselves, okay, this is going to be our area when the market comes back up, that it's going to allow us to short the market and then also be in a trade. Let me add these in quickly, okay? So here are these little pockets here of supply, sell zones, and we're going to mark them all the way down. I like that a little better. And when the market touches all these, there's another one. That's actually a great zone retracement, and then continued going down. So as the market gets lower and lower, these zones, the validity of them become weaker and weaker, okay? So let's just focus on the very bottom, because that's where we're waiting for a shift in the market. So this very bottom zone, okay, was made based off of this candle and also the previous candle. You can see here the open of this candle, this area of the candle, the very bottom, makes that zone go to the far right. So that's your entry. Your stop loss is protected above it. But now the market has shifted, okay? So this is your number 1 right here, your zone. That there. Now what's happened here is the zone has been broken. A higher high has been made where it's obviously a trend. We can also look even lower. This move here is also a zone break, what I call number 2. So let's keep that there, and let's make another one of these and get an even better end. So selling pressure, there's a zone in there. There's another supply zone, believe it or not, in there. But this is where you see the engulf candle. That is broken. That is the tell of the market right there that it's shifting. And what we do is we get in, not in the close of this candle, even though obviously it's shifting. We don't just chase it. We wait for a retracement. So that's where we have number 2 is the zone break. Now we wait for the retrace. So when we look into this though, we're going to, where do we get into the retracement? So if we have this bullish move, that's our tell that now everything has flipped and now we want to make. So that's where, and close. It's this candle here to the left. We're going to drag that all the way to the right. So that's our entry and our close. So we can look at this and say our entry is right there and our stop loss is just below it. But there's a spread to this currency pair. So we're going to add the spread size to our stop loss. And that's going to be, about 3. We have 1, 2, 3, and 4. We have the zone right here, the zone break. Number 3 is the retracement, and now number 4 is our zone touch on the bullish side. And that's what this what this candle did right here at our demand zone. So we can get into the market literally going to each area, each supply zone, all the way up. A lot of guys are bullish, obviously, and that's why the market did what it did. See, is a monthly chart, so you can get down on a lower time frames. You can adjust zones on your lower time frame, so you can just take nothing but bullish trades for an entire 2 years. Because obviously this is January of 2012, and it retraced to obviously September, October of 2012. So patience pays off. So from all these little areas, though, knowing that these are now freight train long candles, momentum's in the market, you can get into lower time frames and trade those zones and be on the right side of the market. So the thing too is that the market here, it's going to react at each supply zone and here, but it doesn't print a bearish candle. It doesn't print a lower low in this direction. So blow through these. So you can just look at how it reacted here, and actually it formed a pennant here, so you can see there, and then it broke out. So that was kind of some stalling in the market though. But what's going to keep it going bullish? It's the fundamentals. It's what the BOJ's doing. It's what they're doing with their 2% inflation. So get rid of that. Now we've got some more demand pockets in here. Here's a really good one I like too, is we'll move that right in there. I'm going to look for longs also, low risk reward. There's an engulf. The black candle to the right is the engulf, but the zone is the previous candle, and it went up, came down, retraced, boom, you just get in at the top line, protections below, and let it ride. So that's just some examples. There's a lot of different, this is just pure candlestick formation trading. This is not indicators, moving averages, CCIs, stochastics. This is just zone brokens, 1, 2, 3, 4, and it just simplifies things.